Ladies and gentlemen, welcome to the panel discussion, which is the highlight of the ETF Conclave. We have our panel of experts here, and today we will be talking about ETFs, ETF strategies, and how Indian investors can benefit from ETFs, as well as how global investors have used ETFs. To begin with, I would like to start off with Hansi. On what is the importance first of asset allocation for private clients as well as wealth management clients, and how can they consider or should they consider ETFs as an investment avenue?
Okay, well, thank you very much. Good evening, everyone. So the question is on asset allocation. I guess there's the two parts to it. One is the strategic asset allocation, and then there's tactical asset allocation. Most investors realize that most of the value add or most of the returns come from the strategic asset allocation, which is basically the allocation to which asset class, whether it's equities or fixed income or commodities and so on. While most people realize that, it's human nature, I think, that people want to, even though they know most of the returns come from the market, the beta, they want to outperform the market or beat the market, and they want to get access to the alpha. And hence, either they pick stocks themselves or go to fund managers or brokers and so on to try and get the alpha return. So the first thing is that's what they're trying to do, and then therefore they tend to go towards active funds rather than ETFs. Deborah, you mentioned that there are some active ETFs as well, but broadly I'm using ETFs as a proxy for index funds. So it really becomes an active-passive debate. So to get to strategic asset allocation, people are basically using active managers. The second thing is, then because it becomes an active-passive debate, the question is it better to go active or passive? And that depends on the asset class. And it also depends on which market and when. An example of that is as fixed income, for example. When I started in Australia 20 years ago, fixed income was primarily a government bond sort of market. And it was very, very hard for active managers to outperform. And therefore people thought, okay, you know what, why pay active fees? We might as well go index. But as the corporate market developed or the credit market developed, a bigger chunk of the indices became credit. And there it's counterintuitive. Think about it. I mean, if the more a corporate issues credit or issues debt, the bigger part of the index they become. So the more indebted they are, the more people want to give them money, which is not a good thing. So therefore, the industry started going active. So there, again, index ETFs or bond ETFs, a question would become, do you really want to go index or passive in bonds? I started with also saying tactical asset allocation. I think that's where ETFs become most useful. So if you make a sort of a strategic portfolio and you decide on your core and satellite, depending on whether you believe active or passive in certain asset classes and what time, that becomes a core. Then the question is, can you beat the market by doing tactical asset allocation? I shouldn't say beat the market. Can you add value by doing tactical? And there I think institutional investors think about it as tactical overlays. So they don't touch the underlying portfolio, but they implement changes through ETFs or other sort of derivative contracts. Advisors could look at that as one way of using ETFs to tactical. The problem there, however, is that most wealth firms, not just in India, but even I've worked in Australia, Singapore, Hong Kong, don't really have a very good or set framework for doing tactical asset allocation, as in what sort of deviations they would want to take from the midpoint or the strategic asset allocation, how much they're allowed to deviate. It really becomes person dependent. So the head of research or the head of investment advisory makes a certain call, or the broker makes a certain call, and they implement that. But it's not a very systematic sort of approach. So then again, hard.
Right. And therefore, how would the same effect be felt on the underlying, which is, say, actively managed, and you have a fund manager who's taking a cash call, say in a bond fund?
So you're asking me people should do that or not do
I'm
that?
asking you how would that affect? Because the same problem arises there. When you're taking a tactical call, it's a call.
Yeah, it's a call. Personally, I've, as I said, again, worked for institutional clients and for retail clients. Institutional clients prefer the fund managers not making a cash call because they are making the asset allocation call. But retail investors expect fund managers to make the call. I think it's only valid that as they're giving money to the fund manager who supposedly should know the market better, that they actually make the call. So they would give the money, or they would prefer an active manager make the call, and therefore I would give my money to an active manager rather than ETF.
That's interesting. Manu, from an institutional perspective, and you've been on Delta One desks, you've been on the P-note issuance side, you've been doing swaps and so on. How would institutions use ETFs, or how can they use ETFs right now as opposed to what Hansi just mentioned?
Yeah, I mean, we in Citi have been sort of a great believer in the fact that ETFs are the way to go. And not only on the institutional side, Anubhav, we have also been sort of on our retail and on our private banking side, we have been trying to push ETF products. We believe that this is a product which is good for the investors. So on the institutional side, we have tried to sort of use ETFs in an innovative way, especially when we are designing new products. So for example, we wanted to come up with a quant kind of a strategy, and I think that's something which we have seen more and more strategies which earlier were bundled through a portfolio management scheme or through a collective investment schemes. They are now being bundled in an easy manner through an ETF kind of a product. And that's where the beauty of it lies, right? I mean, ETF is simple, it is exchange traded, it is easily available for the retail investors for them to sort of participate in it. And at the same time, if there is a good strategy that can be built into it, like a beta neutral strategy or a volatility balance strategy, it sorts of builds in and sorts of meets the investor's objectives as well. So I think, I believe that ETF from that perspective on institutional side fill a great gap, which earlier, was a difficult gap to bridge in a way. And secondly, ETFs also, I think, help in asset allocation, as we have discussed a number of times. It may not be a simple asset allocation, which is, for example, as an investor, I would typically say I want to invest 20%, say, in a commodity-based product and balance, say, in an equity-based product or whatever. It could be a more kind of an ETF itself giving a dynamic asset allocation, like we have seen some fund managers coming out with that kind of product, where ETF itself sorts of balances, or sort of an umbrella ETF, which is balancing between maybe 2 or 3 different ETFs. One is a commodity, other is a fixed income, and then sort of taking a call. So I think ETF again there comes in from as an institutional provider of ETFs, as an institutional provider of quantitative stuff. I think that's where on the institutional side ETFs do come and fill in the gap. Yeah.
Right, and we've been talking to a fair number of institutions. Motilal Oswal itself has a fairly large institutional desk, and one of the questions that we're asked always is how can we use ETFs as a trading product only, and so we'd like your views on that.
Yeah, I know. ETFs as a trading product, forget ETF. For any product to become a trading product, it needs to have a certain mass of liquidity for it to be able to become a trading product. Now, I know it's a vicious circle. Trading, the liquidity brings in more liquidity and then brings in more trading, and then, it sort of builds up. Madam Chitra mentioned in her opening remarks that, once arbitrageurs come in and, government has done fair bit of stuff in terms of bringing down the STT on ETFs and allowing different kind of investor classes like pension funds, insurance companies to invest in ETFs. So I think once that critical mass comes in, and then I think we have a vibrant futures market. So shorting of the underlying basket should never be an issue in India. So I think once the critical mass of, I would say ETF AUMs come in, equity ETF AUMs, then you would see trading community come in and step in and provide liquidity to that, that further liquidity would come in on back of that. I think that's where the trading from institutional side will start picking up.
Excellent. Deborah, I'd like to draw on your experience. The other thing that we see in global conferences, meetings with global investors and domestic investors, is this concept of liquidity in ETFs. It is something that has given us much to think about, as well as a lot of debate has been out there. So the ETF does not trade very actively. Is it liquid? And from the service providers, we get to hear, yes, it is. From manufacturers, we get to hear, yes, it is. From the investors, they say, no, it's not, and we should not invest. So if you could give us a little bit of insight into the liquidity in ETFs, as well as how liquidity affects a bunch of other factors which are responsible for trades.
Sure. So I think if you look at ETFs, I think liquidity is a bit different in the US versus Europe. So if we look at the US, all trades are reported very quickly. And every day in the US, ETFs account for around 28 to 30% of all equity trades. So if you were to open a newspaper in the US and look at the 10 most actively traded securities, typically you would find 4 or 5 of them are ETFs. And that's been reality for a long time. The challenge with liquidity really happens mostly in Europe, and that's partially because of a quirk in regulations. In Europe, under MiFID, which is a set of regulations, ETF trades do not have to be reported on exchange. So the reality is only about 1/3 of the trades are reported on exchange, and the other 2/3 are done on an OTC basis. So when you look in Europe at an ETF, many times investors will say, well, gee, that ETF doesn't trade much. I'm concerned. So you have to remember what I said earlier. There's 2 ways of trading an ETF. You can trade it just like any other stock, but if it isn't trading a lot, firms like Citi are authorized participants, and what that means is they can trade the underlying basket, typically in units of 50,000. That creation basket gets sent to the manager, and the ETF gets bigger. Now that sounds potentially scary for you guys because you're thinking, well, how do I know if I need to ask for a creation or redemption or something else? The reality is what you need to do is when you call your broker, just say to them, how much would you like to trade? How would you like to trade it? And they will really help understand whether it is a creation or a secondary trade. Typically what you find is the threshold is normally if your trade is more than 20% of what normally trades an ETF, they go and source the underlying. And the underlying in most ETFs would allow you to do a lot more than what is done in the secondary market in the ETF. So ETFs really are liquid, and they have many tools that can help you do that and understand the true liquidity.
So would it be fair to say that the liquidity of an ETF, given the ability to create or redeem unlimited quantities of the underlying basket, is essentially the liquidity of the index itself, or the market capitalization of the index? Because till you have the market capitalization, you would be able to, well, in theory, create unlimited quantities of ETF shares.
Correct, that's definitely true. And we've seen some large investors who decide to use ETFs because they're making a new allocation, trade billions in an ETF and not have market impact. So it's done very much like a program trade.
And does this affect factors like tracking error, for example, when you have large number of creations and redemptions, or?
That's a good question, but it doesn't, because when you think about an ETF, and let's take something simple like, say, an S&P 500, if there's a creation, the creation basket is basically that list of 500 stocks in the right weight. So what they're doing is going and trading a slice of the S&P 500, the right list of stocks in the right weight, and they send it to you. So it's not going to impact how well it tracks. And most ETFs track their benchmark very well because most of them are fully replicating, so tracking what the benchmark does.
Excellent. Rajneesh, let me bring you in here. So we've created an ETF. We have great uses for ETFs. But the other area that nobody ever speaks about is management of an ETF. And the other question that comes up, so what is my risk on Motilal Oswal Asset Management when I buy an ETF? How is the counterparty risk managed in an ETF at all, if there is any? So could I have your views on that?
When one looks at ETFs, ETFs are just like mutual funds. They're held by trusts. So all the shares that the ETF holds is held by the underlying trust. So from From an ownership of the underlying stocks, it's essentially a mutual fund. There is no risk that an investor has on Motilal Oswal Asset Management per se. It's the trust that owns the funds. As far as the counterparty with whom the ETF or the mutual fund itself is trading, we essentially trade on the exchange, and the counterparty is the exchange itself. So the counterparty risk is not there. Also, a lot of times ETFs, because they have idle stocks, they are lending these stocks in the markets, and they are also, unlike developed markets, in India, the counterparty to all stock lending is the National Stock Exchange or the Mumbai Stock Exchange, the NSCCL and the clearing corporations there. So from a risk perspective, the counterparty to all trades that the ETF is doing is nothing but the exchanges in India. The situation is slightly different when you look at US or other markets. There the counterparty risk comes in because the settlement is not at a strict T+2. In India, every trade has to settle at T+2 on the equity side or on the SLB side on T+1. In the international markets, and our experience spans from trading in the US stocks, the settlement is T+3, but it could extend as long as T+30. So your counterparty risk is now for 30 days. It's not an exchange guaranteed trade per se. It will settle, but how long will it take for settlement and when will the cash come to you is unknown. So there is a risk there. But from an Indian perspective, we don't see that happening.
So in effect, we are a more efficient market as compared to the biggest equity market that is out there.
You can say we are, but pointing out efficiency doesn't come just because of counterparty risk. It comes from other parameters like liquidity and other stuff that the panel members were talking about.
Which brings me to my next question to you. One of the biggest attributes of an ETF is low cost. And low cost is something that we come to by activities such as securities lending, as you mentioned, execution. What are the other factors that affect cost, and how is that used to manage the most looked at statistic in an ETF, which is the tracking error?
Well, when you look at costs to an ETF or costs to a mutual fund, they're essentially the total expense ratio, which incorporates management fee plus other expenses that are allowed to be charged to the scheme, or along with that brokerage costs, the securities transaction taxes that need to be paid. When the ETFs are trading, there is market impact on the trades. The way we go about doing, trying to manage these things is try to negotiate very hard on the brokerage costs. STT is something that you cannot negotiate on because that's a government dictated number. Negotiate as low an STT brokerage cost as you can. Try to come up with products which have reasonably low total expense ratios. And on top of it, lend as prudently these stocks that are held passively by you in the market at probably as reasonable a return that you can get, so that the investor money or the securities that are lying with you can earn some portion of the expense back. That's there. As far as market impact is concerned, the way we think is prudent is the asset managers should not be looking at trying to take a call on timing the market. Like you said, institutional investors are looking at having the money fully invested. Retail investors are looking at having the fund manager take a call. Unlike that, most in India, the ETFs are mandated to have as close a replication to the underlying as possible. So we are essentially trying to mimic it. So tracking error can be minimized by keeping a very close tab on complete replication of the basket.
Excellent. And also, one of the other questions that we get asked is, an ETF mostly is based on an index which is passively managed. So if the fund manager is not taking a call, what are the different roles does a fund manager have in the ETF space? And how is that the fund manager drives the ETF business itself?
We talked about investment strategy-based ETFs, and I believe there are in India, the ETF space is very small. Madam Chitra talked about numbers being low from a ETF space. We have 36 ETFs, all tracking a single or two indices, one gold, one the large cap index in India. When you look at ETFs beyond that, there is a BankX out there. Our view is most of the AUM in a particular index-based product goes to the dominant player, and over a period of time, that dominant player tends to become the most efficient provider of that particular index-based ETF. It may be because the ETF provider started first in the game, or because the ETF provider is doing something unique in terms of managing the cost structure that the total expense delivered to the investors is probably the lowest one.
So in your experience, so what's the best that you've achieved in terms of lowering the cost?
Well, let's look at it not just at the cost that we have achieved at our funds, but
The delivered cost to the investor.
I'm going to that because the forum is slightly broader. So let's say if you look at the market in general, the ETF industry is trying to use stock lending, low cash levels, and low trading costs to reduce the cost structure. Some fund managers have been able to deliver costs as low as 25 basis points to 50 basis points, even though management fees are much higher. And so that's there. So we'll keep it that way rather than getting into specifics about our funds.
Certainly. We'll give you a pat on the back later on. Hansi, just moving on to the Indian markets now, what's been your experience, or what have you seen out there with regards to adoption of ETF and asset allocation strategies with advisors, even if it is not within asset allocation strategies? And if yes or if no, what are the reasons that you can think of that that's the case?
So specifically, I haven't asked the Indian wealth management market. In fact, I should say there's a form that everyone should fill out before they leave. So I will have the answer at the end of the day. So I haven't specifically asked the Indian market, but my experience with advisors in, again, overseas markets is there's three issues. There's the infrastructure issue, cost, and the product design. The infrastructure is that advisors tend to be mutual fund distributors. So they're familiar with the way they go and invest in mutual funds, which is an unlisted market. So go to ETF, they have to become or associate themselves with the whole sort of stock exchange infrastructure, which in a lot of markets they're not familiar with and don't want to. Then they have to deal with both sort of platforms. The second issue is cost. In a lot of markets, regulators are now banning commissions and moving towards fee-based advice, which in markets like Australia has led to advisors now using ETFs to advise clients so that they can justify their 1% fee of advice, because the total expense ratio, including advice, really can't be more than 2.5% when the total return is barely 10. So in India, again, the investment advisor regulations have come in, but it's yet to be seen whether that will drive people to either use direct active funds or ETFs and therefore be able to charge fee for advice. But certainly that's triggered the take-up of ETFs or index funds in Australian markets. The third thing, I think, as a researcher all my life, 20 years in research, I kind of think there are markets or asset classes that you need to go active. And there's a reason for it, because the whole market cap sort of basis on which indices are based, and ETFs are based on the indices. So the more recent launch of fundamental indices should change that. And therefore, the whole smart beta concept might lead to better designed indices and therefore hopefully adoption by retail or advisors or investors. With the knowledge that they can actually invest in something and then not be led into a lull, which, for example, the tech boom or any boom for that matter can lead them into.
Right. Manu, in your experience and over the last couple of years, what's the trend that you've seen in terms of adoption, in terms of use by institutions or even private clients at Citi or in the region itself?
I mean, Deborah covered that in her presentation as well. We are seeing, there is an increasing trend towards the usage of ETF. And the ETF is primarily used by, I would say, passive investors. So for example, there's a big endowment fund in US, couple of $100 billion. They don't want to employ a lot of fund managers, portfolio managers actively managing that fund. So they will say, okay, I will allocate part of that money to a passive ETF. I want to say invest in Asia or in GEM. So they will allocate part of that money into GEM funds. So there is a Vanguard GEM fund or there is a BlackRock GEM fund. So that will attract money for that. So for example, more and more we are seeing that, passive money coming into this. And then, of course, there is a retail and that investors who are, of course, part of this big pool of investors into this. So when we in Citi look at potential ETF business coming in, it is primarily driven by the big endowment funds, pension funds overseas, and I think that's a development which is happening in the Indian market right now as well. I would like to add that from India's perspective, what do we learn? I mean, how do we use that experience which we have? I think as financial intermediaries who are present here and overall in India, I think it has to be seen as a business which has to be invested in, right? I think, Motilal Oswal, other asset management companies are doing their bit, exchanges are doing their bit, but this is where you invest in. It's like, the payouts are low because expense ratios are low, and they are low because, of various reasons that you don't have to invest on research or whatever. But then as the corpus grows, the money starts coming in, right? I mean, it's like whether you are making 50 basis points on 100 crores or suddenly you start making 50 basis points on 1,000 crores, and that's where the money comes in, right? So I think that's the trend. I mean, the investment has to be into the grassroots, into the fact that we build the infrastructure here. We do more seminars like this. We do more conclaves. We get into the tier 2, tier 3 towns and cities, attract more investors to invest in. And then that's where once we get the corpus in, and then we start monetizing. And that's what we have seen globally also, the trend which has happened over last maybe 5, 6 or 7 years. Yeah.
Denny, one of the things that Hansi just mentioned was the smart beta. Could you share with us what that is? Because it seems to be the in-between space between completely active management as well as the headline indices that most ETFs invest in.
Yeah, so for many people, smart beta refers to an index that's not market cap weighted. So it could be equal weighted, it could be fundamental, it could be minimum volatility or minimum variance. So what we have seen is, as was mentioned, many investors would like to do better than just market cap. So what you have found is many of these methodologies can deliver above market cap performances in many market cycles. The thing you need to be careful about is think of a market cap weighted index and then think of equal weighting the stocks. You tend to find that you'll have a small cap bias because small caps get weighted higher. So if we move into a market cycle where large cap is doing better, an equal weighted benchmark is not necessarily always going to do better than a market cap. So you need to be aware of the differences in methodology, but this is an evolution that we see happening, and it is an area where investors are trying to put money to work, and many of the consultants are quite positive on looking at these methodologies. But most of the assets today are still sitting in market cap indices that all of you know and understand. So S&P 500, the CAC, the DAX, MSCI World, MSCI Emerging Markets, or Nifty, or other types of products.
Okay. Towards the end of this panel discussion, could I ask all of you to give your collective thoughts on where the space is and where it is headed from what you've spoken or what others have spoken? Rajneesh?
Well, to us, from an Indian perspective, we believe that we need to educate not just the retail investors, but the institutional investors, given that the pension and the insurance players have just been allowed to invest in ETFs. So maybe over the next 2-3 years, we need to educate them, help them understand the markets a little better, partner with market makers and authorized participants to help improve the efficiency of the market. And given the steep reduction in STT, which led to a round-trip cost of 60 basis points dropping to as low as 2 basis points, we believe efficiency of the market will increase. So if we can work with various players as providers of ETFs, we believe the efficiency of the market will improve, and new players and new money will come in. So over a period of time, the assets under management from various players should increase. Obviously, you need to launch products which are differentiated. So you may talk about products which are not available, even if they are market cap based, or maybe smart beta strategies that the entire panel is talking about. And just mentioning it, we probably have been the first ones in India to talk about smart beta and launch a product on that.
Thank you. Hansi?
I would say there needs to be stronger sort of research on the whole active-passive debate in India. And having said that, I think there is a place for a core and satellite portfolio, given that most returns come from beta. And most retail investors don't have access to good research in terms of when to change managers and stuff. A good part of their portfolio should be in passive. And ETFs are a good cost-effective way of doing that. In fact, when I was consulting to the PFRDA, they, like many other pension funds around the world, decided to go passive on that basis. So yeah, I'd say that more education on the whole core and satellite approach. I wouldn't go all passive. I think that is dangerous for retail investors. I think there should always be some active management to be able to make that call, especially into cash. So I'd say core and satellite education would be the way to go.
So we're talking about shrink-wrap products, or are we talking about something that gets built through an advisor?
It depends on the audience. Depends on the audience. For retail investors, you need more packaged, balanced type funds. So again, the new pension system is fantastic design for retail investors. For high net worth investors or anyone who can afford to pay for advice, by all means, you can have a custom-made product that actually does take into account strategic asset allocation, value add from active management, and value add from tactical asset allocation, which is where ETFs are fantastic.
Debbie?
So I think what's happening here in India is quite exciting, and what it really takes is ETFs need an ecosystem to work, because at the end of the day you have the provider, but when you want to buy an ETF, you need to go to a bank or broker, and they need to be on an index that people need to understand, and the exchange has to be there to support the trading, and the tax and regulatory environment needs to be right. And so I actually, coming here a couple days ago, see that really you're on the cusp of things really moving in a very positive direction where regulations and tax are changing, and everyone is really working together like this event to educate, because I think that is the challenge, is to make sure people understand how to use the products. So I actually think it's quite exciting to come back here and see what's happening.
Manu?
Yeah, so in my view, I think there are two things, right? I mean, one is, of course, we need to get more investors in, and I think the efforts are in the right direction. A lot of effort is being done by exchanges, by us as participants. We are doing all the efforts to create the interest, to educate the investors. And as Indian economy grows, I think we will see more and more flows getting channelized into savings and then into various financial products, and ETFs would be there. And secondly, I think Rajneesh, you briefly touched on the new product thing, and we have talked about smart beta. I think that's where I think the innovation can really come in. So for example, today if an investor wants to buy a bank product, I think the only bank product which they could probably go for right now is a bank future which is listed. But then the way it is weighted more towards 2 or 3 banks, and then you end up taking exposure on those 2-3 banks rather than having a broad bank kind of exposure. So an ETF can come and fill in that gap, right? I mean, you can have a more broad-based kind of a bank index. And similarly, I mean, I am an institutional investor. I believe that it's time to move into a high beta. But then either I pick up the stocks which are high beta stocks and invest into that, or if I have to go into an index, there's nothing there. I mean, maybe we can think of an ETF which tracks a high beta index, which is a mix of few kind of stocks which are high beta, and then gives a sort of a diversified risk thing there. So those are the kind of product innovations which I think will help the market, and I think it's at the right cusp right now where those innovations should come in and should demonstrate that they can sort of give that kind of diversification which an investor would typically look for.
Thank you. That was very insightful. What I'm going to do is a little later, I'm going to summarize some of the discussions and the presentations that we've seen. Right now, we've spoken about some new concepts like smart beta. We've spoken about where the markets are headed in terms of ETFs. We've spoken about the roles of active management, passive management, and a bunch of other strategies in the ETF and the investment space. I'd like to now thank all the participants for your kind insights and your sharing your experience with us. What I'm going to do right now is to provide a small snapshot of what we've discussed so far and how ETFs are relevant to what we do both as asset managers, investors, as well as advisors. A couple of things that we've seen is that an ETF, as Deborah's slide said, is a very democratic product. It is useful for institutions, it is useful for advisors who basically advise on the wealth management as well as the private banking space, as well as for retail investors. A couple of reasons why these ETFs are exceptionally useful is because of cost, because of transparency, because of all the flexibility that it allows different advisors, investor classes, and managers at the treasury levels or at the fund level to allocate assets, to basically manage strategies. Some of the, but having said that, a couple of differences that come in as to how ETFs are used in different investor classes by either intermediaries or directly by the investors themselves. Now, for institutions, the first thing is that institutions tends to be a fairly sophisticated marketplace. Institutions would like to use ETFs both as investment and trading products. In addition to that, institutions can use ETFs for strategies such as long-short strategies, for low volatility strategies, and basically use ETFs to attain objectives that are either set by the regulators, by their investors, or by their own investment committees and risk managers. At the advisor level, we can again divide that segment into two classes. The first is the private banking segment, where the nature of the mandate tends to be very bespoke, to the extent it can be actually very client-specific, to the extent, and then going on to a diverse range of strategies that we've seen a lot of private bankers use over different clients. Now, ETFs can be used out there both for generating alpha, for capital preservation, or for developing sophisticated strategies which have very, very specific mandates from the clients. And on the wealth management side, again, these can be either DIY or advisor-driven. But they can use ETFs in pretty much the same way that private bankers use, except we tend to have a more limited number of strategies as the needs of those investors can broadly be bucketed into 3 or 4 types of investment objectives. These could simply be your traditional moderate, aggressive, or conservative investments. Objectives can range from capital preservation to returns, or they could simply be a demand for maximizing Sharpe, i.e. the best risk-adjusted returns that are possible. On the retail side, however, as Hansi and Deborah both pointed out, we tend to have a requirement for shrink-wrap products, which means that all the rocket science needs to happen at the back end. The retail investor can get into things like target date funds, which simply adjust risk on the portfolio over a period of time. They can get into static risk products where the investments can just correlate to a certain risk return profile, or they can be specific objectives that we can see in terms of constant duration, income products, and so on. On all of these places, passive and ETF products can be useful. That's the summary that I have.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.